I think that in going into the business, they dreamt up a lot of reasons for it. They said they're both in the risk business and their clients were going to demand it.
A pressing matter demands every investor's attention in today's rapidly changing investment landscape. It isn't about the latest trends or quick tips. It's an urgent warning that could shape your financial future. Let's discuss the details. Right now, it seems we're on the verge of a significant financial event. A global margin call is looming, and the signs are too glaring to ignore. But what does that even mean, and how does it affect you? All right, let's break it down together. Market dynamics are like the heartbeat of the investment world. They dictate how assets move, and understanding these dynamics is crucial for active investors. Why? Because it's the difference between making informed decisions and shooting in the dark. Think of it like this. Would you drive a car without understanding how the brakes or accelerator works? Probably not. Similarly, driving into investments without grasping market dynamics is a risky move. Now, let's dive into margin calls. Have you ever heard of a margin call? If not, let's simplify it. Imagine you've borrowed money from a friend to invest in a business. If that business starts to fail, your friend might get nervous and ask you to return some or all of their money. That's how margin call works in the investment world.
It's just like a margin account. And when you sign pieces of paper like that, you can go absolutely broke into default and catastrophe and having other people liquidating your positions under distress conditions, et cetera, et cetera. So there's a lot of irresponsible mechanics in attempting to protect themselves. They've introduced this enormous instability into the system through all these clauses about collateral posting.
When you invest using borrowed money, it's called buying on a margin. Now, if the value of your investment drops significantly, your broker might get nervous, just like your friend. They may then issue a margin call, requesting you to deposit more money into your account. It ensures that the amount you owe is, at most, what your investments are worth. But why does this happen? Well, a margin call is usually triggered when the value of the securities in a margin account falls below a certain level. This could be due to various reasons, like market volatility or a significant drop in stock prices. And when this happens, you, the investor, have a choice. Either deposit more funds or sell some of your assets.
Their capital would have shrunk. They would have had way more in equities, which would have shrunk further, and who knows how far, at the time, how far it would have gone. Plus, they would have had, in my view, they would have been downgraded quite significantly, and that might well have triggered things in their derivatives activities, which would have required coming up with loads of cash.
Let's take a look at a quick example. Suppose you bought securities worth $20,000, but half of that amount, $10,000, was borrowed. If the value of those securities drops to $14,000, your equity, or the amount you genuinely owe, becomes $4,000. If your broker has a maintenance requirement of 30%, they'd expect your equity to be at least $4,200. In this case, you'd get a margin call asking you to deposit an additional $200. Now let's switch gears a bit. The euro-dollar system might sound fancy, but it's essentially about US dollars deposited outside the US, mainly in Europe. It's a significant part of the global financial system and plays a role in how interest rates and foreign exchange rates are determined. Practically, it is more like you depositing them in a bank overseas or an offshore branch of an American bank. However, these deposits are not limited to Europe, as you can find them in the Bahamas and the Cayman Islands. Cool, right? So why would anyone do that? Great question. One of the main attractions of Eurodollars is that the Federal Reserve Board does not regulate them. It means they're free from specific requirements that typically apply to deposits in the US. And guess what? It often allows these deposits to offer higher interest rates. But of course, with higher returns come higher risks. Since they're held outside the US, they're exposed to the political and economic conditions of the country they're in. The Eurodollar market isn't just a small niche. It's one of the world's foremost international capital markets. It's like the big league for financial professionals. And because it's so vast, it requires a constant inflow of deposits. If for some reason the stakes were to decrease, the banks involved could face liquidity issues. Most of the transactions in this market are short-term, often overnight, but there are also long-term transactions, usually done through certificates of deposit. And the volume? It's massive. On average, the market sees a volume of around $140 billion.
When you get margin calls for huge amounts of money, it only has to be one day when you can't meet it. That almost happened. If you go back to October of 1987, there was a large wire transfer that didn't make it to the clearinghouse at the in Chicago, and that came close to halting the whole system at the time. And we were very close to closing the exchange, and a lot of things would have unraveled.
If you're wondering how the euro-dollar market came to be, it's a tale that takes us back to the aftermath of World War II. Europe was in ruins, and the U.S. stepped in with the Marshall Plan to help rebuild the continent. It led to a lot of U.S. dollars circulating in Europe. Over time, a separate market developed for these dollars, free from U.S. regulations. And that's how the euro-dollar market was born. So, while the euro-dollar market offers attractive interest rates, it's essential to remember that it's not without risks. The Federal Deposit Insurance Corporation, FDIC, a U.S. government agency that provides insurance on bank deposits, doesn't insure these deposits, and they're subject to the whims of the political and economic landscape of the country they're in. So, moving on, let's discuss the factors influencing the financial market, especially the role of the interest rates and how they can lead to a margin call. The role of interest rates and their potential rise. Interest rates are like the heartbeat of the financial world. They influence everything from the loans you take out for your home to the returns on your savings account. But have you ever stopped to think about why they're so crucial? Higher interest rates can actually improve net interest margins for banks. This is because the rates charged on loans and earned on investment securities also increase. So, when the Federal Reserve decides to raise interest rates, it's like giving a little boost to banks. They can potentially earn more from the loans they give out. But here's the catch. While this might sound great for banks, it's not always sunshine and rainbows for everyone else. So how can these factors lead to a margin call? Now let's connect the dots between interest rates and margin calls. When you trade on margin, you're borrowing money to invest. It can amplify your gains, but it can also boost your losses, and interest rates play a significant role in this. As per Investopedia, a margin call occurs when the value of an investor's margin account falls below the broker's required amount. This can happen when the securities, stocks or bonds, purchased with borrowed money decrease in value. When interest rates rise, it can decrease the value of certain securities, especially bonds. If the value of the securities drops significantly, those margin trading might not have enough equity in their account to cover their loan, leading to a margin call.
Dangerous to have a system where people are depending on billions of dollars coming in from other people. Well, we had that on Solomon on that Sunday in 1991. If Solomon had gone bankrupt, the next day you would have had people on the other side of 1.2 trillion of notional amount of something like that of derivatives who would have had a contract with a party where they would have been dealing with a bankruptcy court. You would have all kinds of security settlements that wouldn't necessarily have settled. You would have all kinds of confusion.
But why does this happen? Well, when interest rates rise, newly issued bonds come with higher yields, making older, lower-yielding bonds less attractive. Their prices drop, and if you've bought these older bonds on margin, you could be in for a rough ride. So the next time you hear about the Federal Reserve raising interest rates, remember, it's not just a headline. It has real-world implications for investors, especially those trading on margin. And while rising interest rates can benefit banks, they come with challenges that must be navigated carefully. Remember, the financial market is like a vast ocean, and interest rates are the winds that guide the ships. Let's talk about some strategies for investors, especially in the current market scenario. Investing is like navigating a ship in the vast ocean, and having the right plan can make all the difference. Positioning yourself in the current market scenario. The market landscape is in a perpetual state of flux. For investors, this means that there are other options than staying static. You must be agile, adapting to the ever-changing tides and ensuring you're positioned optimally. A 2022 article from Drew's editorial team shed light on this, emphasizing that market positioning isn't just about products or services. It's about how these offerings resonate in the minds of potential consumers. Think about some of the most iconic brands out there. People don't just buy them for their functionality, they buy into the brand itself. So, diving deeper, how can one position themselves effectively in this dynamic market? 1. Unique selling proposition, USP. At the heart of your investment strategy should be your USP. It's the beacon that differentiates you from the sea of competitors. What is it about your approach or method that's distinct? Why should someone gravitate towards your investment philosophy over others? Pinpointing and articulating this can be a game changer. 2. Know your target audience. This is foundational. Before making any move, you need clarity on who you invest for. Is your focus on reaping quick, short-term benefits, or are you in it for the long haul? Your investment goals and the level of risk you're comfortable with will dictate your decisions. So, clearly understanding your target demographic and their preferences is paramount. 3. Stay updated with market trends. The digital realm in particular is akin to shifting sands. What's relevant today might be obsolete tomorrow. Hence, keeping your finger on the pulse of current trends and market shifts is essential.
Educate yourself that it's a simple business, that the issue is not how to pick stocks, but how much to have in stocks. And understand there's a stock and a bond. Ownership versus loanership is what we call it. Understand the incredibly important role of cost in all this.
This doesn't mean jumping on every new trend, but being informed enough to discern which ones align with your strategy. Doing so lets you anticipate potential market movements and adjust your position to capitalize on them. Now let's delve deeper into the concept of diversifying and understanding portfolio allocation. Diversification might not be new to many, but its significance in investments cannot be overstated. So, what makes diversification such a crucial strategy? 1. Spread the risk. Think of diversification as a safety net for your investments. When you spread your investments across various assets, you're essentially safeguarding yourself from the market's volatility. Imagine if you had all your money invested in just one stock, and that stock took a nosedive. The consequences would be dire. But by diversifying, you're ensuring that even if one or two investments don't perform as expected, others in your portfolio might still hold strong. It's the classic wisdom of not placing all your eggs in a single basket, ensuring that the others remain intact if one breaks. 2. Potential for higher returns. While diversification is primarily about risk management, it also opens doors to potentially higher returns. The financial market is dynamic, with different assets shining at different times. By having a diverse portfolio, you benefit from various market trends. For instance, while stocks in one sector might be underperforming, those in another could be hitting their peak. By having investments in both, you can offset losses from one with gains from the other. 3. Achieve more consistent performance. Consistency is key in the investment world. While it's natural for assets to have their highs and lows, a well-diversified portfolio can help smoothen out those peaks and troughs. It means that even when a particular asset isn't doing great, others in your portfolio might be thriving, ensuring that the overall health of your investments remains stable. It's like having a team where each player brings a unique strength. Even if one player has an off day, the others can step up to ensure the team's success. According to the Corporate Finance Institute, determining your company's uniqueness by comparing it to competitors and understanding your current market position is essential to effective market positioning. They also emphasize competitor positioning analysis' importance in developing a robust strategy. Investing is a journey. Having the right strategies can make it smoother. All right, let's wrap things up, shall we? Navigating the financial world can sometimes feel like walking through a maze. Every turn, every decision can lead to a different outcome. So what's next for you? Well, we would say take this knowledge, apply it, and always strive to learn more. And hey, if you found this information valuable, why not give it a like, share it with your friends, or drop a comment? Your feedback helps us create even better content for you. Oh, and before you go, remember to check out our next video. Trust me, you won't want to miss it. Thank you for watching. See you in the next video.